The silver market just received three simultaneous structural shocks. Not one, not two, three. And every single one of them points in the same direction. I've been tracking these convergences for months. What happened this week is the most consequential multi-force alignment I've documented in the entire 2026 cycle. My name is Marcus Caldwell, independent market analyst. I go to the primary sources, the IEA confirmations, the SEBI circulars, the RBI regulatory filings, not the newsletter summaries, the actual documents. What I'm laying out right now is verifiable, sourced, and actionable. Let's build the complete picture. Before I take you through all three forces in detail, if this kind of primary source intelligence is valuable to you, hit that subscribe button right now and turn on all notifications. This channel exists to give you the market intelligence institutions don't want widely distributed. Independent analysis, no sponsors, no conflicts of interest. Your subscription directly supports this work. Now, let's get into the data. Force 1. Oil just broke $100 per barrel. The International Energy Agency confirmed this as the largest oil supply shock in the history of energy markets. Those are their exact words. Now here is why that matters specifically for silver. Between 70 and 80% of silver comes as a byproduct of base metal mining. Every dollar diesel rises increases the extraction cost of every one of those mines simultaneously. S&P Global's mine cost outlook projected global weighted average silver all-in sustaining cost would rise 3.8% to $23.44 per ounce in 2026. That projection was made before oil crossed $100. With Brent now above that level, energy costs have surged for every mining operation on Earth. The cost floor just moved higher again. And the supply side was already contracting before this. Fresnillo, the world's largest primary silver producer, cut its 2026 guidance to 42 to 46.5 million ounces. That is a 9% production cut. Hecla and First Majestic are also guiding lower. Mexico, representing 25% of global silver supply, continues its moratorium on new mining concessions. 25% of annual global supply is legally blocked from expansion at the federal level. And here is the timeline that most analysts are not discussing. Mine development takes 15.7 years on average. Even if a mining company decided today to develop a new primary silver deposit in response to current prices, the first ounce would not reach the market until 2042. 2042, that is the supply response timeline. The BHP Wheaton $4.3 billion streaming deal announced February 16th confirms institutional conviction on exactly this point. When the world's largest diversified miner locks up silver production at 20% of spot, through the largest streaming transaction in history, it signals that physical silver is worth a historic premium to secure long term. It also removes that production permanently from the open market. The supply side of the silver market is not moving toward equilibrium. It is moving away from it. Force 2. India just activated a $970 billion institutional channel. India's mutual fund industry manages approximately 81 trillion rupees, roughly $970 billion. In a circular issued February 26, 2026, SEBI authorized equity mutual funds to invest up to 35% of their assets in gold and silver instruments. To put that in perspective, India has $385 billion in actively managed stock funds. At just 1% adoption, that generates 34 million ounces of new demand. Roughly half the projected 2026 structural deficit from a single percentage point. At 3% adoption, the new demand erases the entire annual deficit. At 5%, it represents approximately 20% of total global mine supply. But here is the detail most coverage has completely missed. This is not speculative demand that a margin hike cycle can destroy overnight. The SEBI ruling creates long-term buy and hold demand from funds that are now required to maintain these allocations to meet new risk management guidelines. Fund managers operating under a regulatory mandate are not leveraged retail traders who get margin called out of their positions by a CME advisory notice. They are institutional buyers with multi-year investment horizons, quarterly rebalancing requirements, and fiduciary obligations to their unit holders. Their demand, once established, is sustained through price cycles. And there is a second mechanism inside this SEBI reform that almost nobody is talking about. From April 1st, 2026, gold and silver ETFs in India will no longer rely on international LBMA-linked pricing. They will use domestic MCX spot prices instead. April 1st, that is 17 days from today. The MCX spot price, the domestic Indian physical market price, has been consistently trading at a premium to the LBMA benchmark due to India's import duty structure, local tax regime, and specific supply-demand dynamics. When Indian ETF net asset values are calculated using MCX prices instead of London paper prices, the NAV will more accurately reflect what Indian investors are actually paying for physical silver in their own market. That transition is the specific mechanism through which India begins asserting its own price discovery authority, reducing the influence of Western paper markets over the world's largest physical silver-consuming nation. Force 3. India just formally remonetized silver. The Reserve Bank of India has officially authorized silver to serve as collateral for bank and non-bank loans under new regulations taking effect April 2026. This is the first time in modern banking history that a major economy has formally recognized silver as a parallel monetary asset to gold in the same regulatory framework governing collateral lending. The practical mechanics matter here. Rural households and small businesses can now pledge 10 kilograms of silver, roughly 321 troy ounces, against loans of up to 2.5 lakh rupees, approximately $3,000. That is how remonetization begins, not at the central bank level, not at the sovereign reserve level. At the household level, where ordinary people begin treating a metal as collateral, as money, as a store of value backed by institutional infrastructure. India is the world's largest silver importer, 1.4 billion people, an agricultural economy where informal credit markets are central to rural economic life. The RBI silver collateral policy is not a niche regulatory change. It is the first formal institutional step toward treating silver as monetary collateral in the largest democracy on earth. Now let me show you what all three forces mean when you overlay them against India's existing demand base. In 2025, India absorbed 6,000 metric tons of silver, 190 million ounces, nearly 25% of global annual mine supply, from one country in 1 year. And here's the behavioral signal that changes everything. Normally, when prices rise sharply, Indian demand drops because Indian buyers are historically price sensitive. Not this time. India's imports grew 44% in 2025, while prices simultaneously nearly tripled in rupee terms. They did not buy the dip. They bought the rip. That price inelasticity, volume growing while prices surge, is the market signal that structural demand is operating, not speculative demand. Structural demand continues regardless of price. And that was before the SEBI institutional channel activated, before the RBI collateral reform went live, before oil hit $100 and compressed the supply side simultaneously. The honest counterargument, stated with maximum force. These are multi-month and multi-year structural forces. They do not produce immediate price responses in the session they are confirmed. And there are real risks to monitor. India's heavy dependence on imported precious metals consumed nearly a tenth of its foreign exchange reserves in 2025. Raising customs duties is under active consideration ahead of the Union Budget 2026. A duty increase from the current 6% back toward the 15% level that applied before the 2024 reduction would widen the domestic premium, potentially slow ETF inflows, and create short-term demand disruption. History shows India's 2013 duty hike failed to permanently suppress gold demand, but it produced significant volatility in the price trajectory. Tata Mutual Fund's March 2026 Precious Metals Outlook recommends a staggered approach for silver, specifically because of asymmetric volatility. Not concentrated buying, not momentum chasing. Staggered position sizing that can survive corrections inside the bull market without forcing liquidation at the worst moment. That is the right framework. Here's exactly what to monitor going forward. Watch the SEBI implementation updates at sebi.gov.in for the AMF, a uniform policy governing ETF net asset value calculation under the new MCX benchmark. The April 1st activation date is confirmed. The specific implementation mechanics are not yet published. Watch India's monthly silver import data from the Ministry of Commerce to confirm whether SEBI activation triggers accelerating ETF inflows on top of the existing physical demand base. Watch the Fresnillo and First Majestic quarterly production reports to confirm whether oil at $100 drives further guidance cuts beyond the 9% already announced. Watch the RBI April circular for the exact loan-to-value ratios, eligible silver forms, and institutional applicability that determine how quickly the remonetization channel activates at the household level. And watch the BHP Wheaton streaming deal structure for whether similar transactions begin appearing across other major producers, systematically removing additional supply from the open market. $100 oil driving mine cost floors higher. India's $970 billion mutual fund industry opening a regulated precious metals channel. The Reserve Bank of India formally recognizing silver as monetary collateral for 1.4 billion people. Three forces, three simultaneous structural catalysts, all compressing the same supply deficit from three independent directions at the same time. The supply side is contracting. The institutional demand side just opened a new channel that cannot be closed by a paper market margin hike. And the monetary side just formalized silver's collateral status in the largest democracy on earth. The question is not what comes next. The question is whether you understand why it's coming before the market prices it in. This is financial intelligence, not financial advice. Verify every source referenced in this video before you act on anything. If this analysis gave you something the mainstream press didn't, drop the word trapped in the comments. That tells me this work is reaching the investors it was built for. Like this video, share it with anyone who holds silver, and subscribe for the next primary source breakdown. Because by the time this convergence makes the front page, the move will already be made.